Central banks around the world have somehow converged to a seemingly magical 2% inflation target. Whether it's Western countries struggling in recent times to bring inflation down, or deflationary economies such as China trying to bring up the inflation marker. Why is there an obsession with this 2% number? And importantly, with protectionism on the rise, is this target even valid at all? Now, it's not ours to value judge protectionism. After all, voters will make that call. However, we do question central banks' obsession, which appears somewhat detached from the reality of a changed world order. And this is perhaps even more relevant in the so called developed economies. And besides, why get anchored to a number rather than ranges as they used to do in the past? Interestingly, a formal 2% target was adopted in the US only as recently as 2012 and arguably at a time of peak globalization. In Europe, the formal adoption happened in 2003, once again as trade barriers continued to get lowered at that time, especially with China joining WTO in 2001. The backdrop to the current targets was clearly an environment of freer trade and very much in contrast to what we are witnessing today and trends that look like getting worse. We should also point out that the source of inflation is as important in determining the antidote. Monetary policy efficacy is debatable in controlling tariff driven inflation, a supply side phenomenon. Sure, central banks' credibility can come into question if you're changing goalposts middle of the game. But we're not talking about trading inflation. We're talking about recognizing structural shifts that warrant a periodic adjustment. Shorter term, all attention is on the September FOMC. Politicians want a cut. Futures are convinced there will be one, but evidence is lacking. The real shocker will be if the Fed stands pat. More details in our report. Good morning, this is Sunil Garg from Lighthouse Canton.